Now here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, was yesterday all a big overreaction? Markets steady, but plenty of volatility to keep nervous investors guessing. All the latest insights from our Friday markets panel. The New South Wales Premier, Gladys Berejiklian, is calling for a breather on immigration levels, but city planners meeting in Sydney today wanted to be full steam ahead. We'll bring you two of the most exciting international urban renewal stories, London's Battersea Power Station and New York's Hudson Yards, as told by their top planner. And after a week of energy summits, what is the latest state of the gas sector in Australia? Credit Suisse's Saul Kavanagh joins me to make sense of markets, corporate deals and political intervention. Now then, speaking of political intervention, Bill Shorten's plans to shake up super made front page news today. The Labour leader at the Outlook conference announced that a Labour government might empower our regulators to force the bank-owned retail super funds to appoint independent trustees on their board. Well, well, well. That is a shot across the bows for the retail fundies, and maybe they deserve it after the revelations, first by the Productivity Commission on returns and then by the Royal Commission on fee gouging that has been going on, all that fee gouging that has been going on. Yes, it turns out, as I've been saying on this show, that the highly controversial Fox and Henhouse ad run by the industry super funds was actually correct. Our chicken, or rather our nest eggs, have been under attack. Yet this latest move by Bill Shorten, I think, should be a gift for the government because it allows the Prime Minister to put the issue of independent boards for industry super funds, also pushed strongly by the Productivity Commission, right back on the table. Labour reckons that with all this fee gouging by the retail funds, that member interests, the super savings workers are forced to place with super funds, were put behind shareholder profits. But member interests are also being put behind other highly questionable agendas in industry super funds, which have close associations with unions. Only this week, Transport Workers Union Secretary Tony Sheldon was called out for egging on industry super fund trustees to use their financial power to threaten to pull investment from companies if they engaged in so-called wages theft and tax rorting. Where are we heading here? Would Mr Sheldon like this industry super threat hang like a sword of Damocles over any company that in this low wage growth environment be under orders to raise wages, even if that impacted board and management strategy, growth and indeed employment? Well, on hearing Tony Sheldon's views, Innes Willocks told the Australian Financial Review that growing the retirement incomes of millions of Australians must not become an ideological plaything. Now, this is interesting because Innes Willocks is not just Chief Executive of the Australian Industry Group, representing employers and businesses. He's also on the board of the nation's most influential industry super fund, Australian Super. Until very recently, the coalition had been arguing vociferously that there were serious governance issues with the union presence on industry fund boards, especially where the employer-elected members were hardly from the big end of town. There was great hope from government and business that Kenneth Hayne at the Royal Commission would put industry super funds under a lot of scrutiny on governance. That did not happen. Instead, the erudite Chief Executive of Aussie Super, Ian Silk, had a Royal Commission light grilling and performed true to his name. The Hayne team has gone for what it sees as the bigger failing of fee gouging on the retail fund side. The government has now dropped any ambition to reform industry super boards, to the delight of militant unions like the CFMEU. But look, Bill Shorten's call for independent boards for retail funds should be applied to industry super funds too. And here, I think, is Scott Morrison's chance. Well, let's head to the world of cyber security now, and a lot going on, from international poisonings, corporate compromisings, right down to personal hacking. Well, Dave Palmer is an ex-British spook, and he's co-founder of Darktrace, which is a very interesting organisation, and I reckon he knows the game at all these levels. He's in Sydney and joins me at the desk. Dave, it's very nice to have you here.
Thank you, lovely to see you.
So tell us a bit about Darktrace and how you see Australia's vulnerability at the moment.
So we're definitely in an era of imperfect cyber defences at the moment. And
imperfect?
Imperfect. I mean, we see this all the time from normal corporates, interesting critical national infrastructure, airports and railways sometimes getting disrupted, and even you know, the Americans, NSA, and Google's and Facebook's having successful hacks and attacks against them. So that tells us that we're in a time where no matter what your budget is and what technologies you bring in, the attacks are still going to get inside. And Darktrace's interest is, how do we catch them once they're inside, and how do we stop it from becoming a crisis?
Right. So your clients are both corporate and government?
That's right, yeah.
Okay. And in Australia in particular, across the corporate sector?
All sorts of different corporates here, and everything through to the services we all rely on. So whether that's water, governmental services.
Well, essential services, yeah.
Essential services, and of course keeping the lights on and keeping the railways and the metros running is pretty important. And so a really wide customer base here. But one of the things that's been coming out in the research generally in relation to Australia is there's a lot of companies that, and organisations that don't feel they'd ever be a target, and maybe they don't invest much into cybersecurity. And the downside of that is organisations like high schools or retail companies, if they do get hacked, they're often used to then attack other Australian organisations and businesses, and it really amplifies the problem for everyone.
Right, okay. So would the legislation that's come in Australia, and I think there's equivalent in Europe now, on having to report breaches, is that making a difference? Are people owning up? Are they fessing up enough?
I think it's a really positive thing for us as consumers and private citizens that, especially when there are privacy breaches, that we'll get to find out about it. We won't be kept in the dark. I have a slight worry that if you're not doing very much cybersecurity monitoring at the moment, then what's your incentive to really lift up the drains and see what's going on down there? No. And so we do need to make sure that we're lifting all boats. That this isn't just a topic that is aimed at the biggest organisations and the critical ones like banks, but that we make things better for really all organisations.
Right, okay. I was speaking to Mark Hughes from BT Security the other day. What makes a Darktrace, or indeed a BT, the place for people to go to? What makes your AI any good?
Well, actually, Darktrace and BT are pretty close partners, worked together for a number of years. I think what the core idea here is that we're really invested in is we've got past the point where humans can guess everything that might go wrong and can imagine all the possible risks and attacks that might happen. So the use of AI really allows us to say, let's let the machines deal with all the complexity, or the people, or the different technologies that we have, and recognize when something strange or unusual is starting to happen, and let us know so we can react to it before it becomes a crisis.
So that does use the machine learning techniques, right? Because, again, I was speaking to Zia Chisti from Affinity the other day. He's got a great big machine learning thing. He seems to make hundreds of millions out of it for his clients. But I'm trying to get to grips with this machine learning, because it really is repetitive trends that sort of build. But you need the skills to be able to input those and then interpret them, presumably.
So there's really two types of machine learning and AI. The type you were describing just there is, how can we leverage human knowledge and data that's existed for a long time about things that are good or bad, and get better at maybe extrapolating some trends, or seeing when something good or bad is happening. The type that we're interested in is all about, don't give the machine any assumptions whatsoever. Just let it go and understand what's in the data, what really happens. Observe the day-to-day behaviours of, say, you and I, and how we interact with business and technology around us. And then just look for things that are unusual. So it doesn't have a view of good or bad. It just looks for things that are surprising and weren't going on before. And it turns out that's a great way of finding cyber attacks.
Do your sorts of businesses, should they be private, or should they be government-owned, or should they be public companies, or does it not matter?
I think one of the worries that many international organisations would have is that if all the cybersecurity products that have access to a great deal of private and sensitive information within organisations were provided by governments, then that puts you into a tricky position, especially if you're a multinational. Do you go with the Australian one, or maybe you're doing some work in Indonesia and they would prefer you to use the Indonesian products. So certainly with the way the economies work now, I'm pretty sure people would prefer these companies to be private.
Yeah, yeah. Moving globally, I mean, we've seen these extraordinary situations with, you know, accusations of involvement in elections in particular. Yeah. Do you worry about, I mean, say there was a referendum on Brexit, or even down here, another referendum on Brexit, or even down here, you know, our elections coming up next year. Should governments be worried at that level of interference now?
I think there's two really important types of risk that they should be worried about. The first is the direct risk of meddling with any digital services that are involved with the election itself. So if you have digital ways of collecting or recording votes, it's really imperative in the current era to be thinking very carefully about where they're protected, how they're protected, who services them, and where all that software and hardware comes from. The broader risk that's being discussed increasingly is how social media channels are being used essentially for subversion, how to influence votes, how to change people's minds on certain issues, and of course fake news keeps coming up over and over again. While the former risk, the technical risks, are something maybe private industry can do a lot in terms of the technical defences, the only regulation is going to make a difference to social media companies.
That's very interesting. That is very interesting. All right, well, we'll end on that note. It's been great talking to you. Dave Palmer, thank you very much.
Thank you.
The Manhattan skyline is changing, down the west side at least, as the massive Hudson Yards urban renewal project is well on the way. Marianne Kwok is design director at Cohn Pedersen Fox and was there from the start of the project. I spoke with her on the sidelines of the Urban Task Force gathering in Sydney today. Marianne Kwok, this Hudson Yards project, it's the most expensive urban renewal project in North America?
In North America.
Tell us a bit about it.
It's 28 acres, 14 acres, which has to be open space.
Sitting on Manhattan?
Sitting on a rail yard, a working rail yard. And so this huge rail yard is right adjacent to the Hudson River. And it really was a black hole in the city. It separated the city from the river, and Chelsea to the south from Hell's Kitchen to the north. And so by building a platform over the rails, and it really has stitched the city back together, north-south, and also has enabled the city to have access to the water.
How important for the business model of the project was the railway station, Penn Station?
Well, it's not really Penn Station, because that's always there and it's right close by, but it's really the extension of the number 7 line, a subway. And the extension of that obviously is enormously important for workers and for businesses thinking of moving.
And that actually happened before the current owner-developers actually took it on, is that right?
It is. Initially, they were planning to have the Jets Stadium on the western. It's basically 2 large blocks, and so on the western block, right next to the river, they were thinking of having a stadium for the New York Jets, a football team. And that stadium was also going to be the New York's 2012 Olympic bid.
Yeah, why did that fall over?
Well, you can imagine. People just hated the idea of it. The idea of a stadium that wasn't going to be used that much, parking, traffic, it just wasn't popular. But while the stadium was being proposed, they rezoned the whole area. And that rezoning also necessitated the subway, because in case there was the Olympics, people had to get there.
So when the current developer, related company, came on board, what were you, as the planner, looking to create?
Well, we wanted to create New York's next neighborhood, and that's the goal of the developer as well.
And what sort of different uses do you have, and are you developing?
We have pretty much everything. There's residential, there's office, there's retail, there's a school, there's a hospital, hotels, pretty much lots of open space, plaza, as well as parks, large art, cultural venue.
And what drives the returns for the owners? What's the engine? Is it the residential side? Is it the retail side?
I think it's all of it. Obviously not the green space, not the public space, but the offices are fully leased, and residential one tower is being sold, and the second one is coming onto market.
So you've nearly finished these two great towers.
We have almost finished our two office towers, and the residential towers, not by KPF, by SOM and Dillerskiff Video Renfro with the Rockwell Group, are almost complete as well.
Right, okay. Now, they are two enormous towers now that I can see on the skyline. Presumably they're not loved by everybody. I mean, how do you deal with local community concerns that is taking away from the sort of culture, the old culture of the area?
There really was no culture in that area, so we were lucky there. And also the skyline of New York is undergoing so much change right now. Currently, I think the city skyline hasn't changed since maybe the 20s or 30s, and so it's a really exciting time for New York. Less visible, perhaps, are the new parks, the renovation of existing parks, pedestrianized streets, bike lanes, all sorts of urban things that make living in New York so much more exciting.
People talk about affordable housing. I mean, this doesn't sound like affordable housing to me.
20% of the apartments will be affordable. Of course, it's an issue.
And what about the balance between the developer risk, the money spent by the developer, and the money spent by the taxpayer? Because, I mean, some articles, one article I've read even suggested that it might be $4.5 billion worth of taxpayers' money in Hudson's yards.
Oh.
Well, in various things, in city capture expenditures, I think they throw in the extension of the train line, general tax breaks, that sort of thing.
I think the train line is paid for by taxes of the new rezoning. So they upzone the area, meaning that there's more density, and that the owners of those pieces of land will contribute to the paying off of the number 7 line.
Yeah, well, it's interesting, isn't it? Because when you're looking at these urban renewal projects, one of the questions is how much should be funded by taxpayers and how much of it should be a developer play?
I believe that the city contributed to things around the area, but not for Hudson Yards at all. That is fully paid for by Related and financing that they got.
Once Hudson Yards is up and running fully, how much of a flow do you see within the city? I mean, are other parts of the city going to lose out to population and living?
I think the west side of Manhattan is really exciting, and for a number of different reasons, but I think a major catalyst was the High Line. And the High Line really has generated a lot of new architecture along the west side. And
when you say the High Line, just explain to everyone what that is.
Oh, the High Line was an elevated rail line that was unused, abandoned, and they have made a city park out of it.
It's a great walkway that you've got.
It's really incredible, and so there's a lot of art galleries along it, new architecture, and I think it brings people to the west side, and I think the far west side has not really had visitors before, and it's very open, and being near the river, it's a wonderful place to be.
Marianne Kwok, it sounds a big and fascinating project. Thanks very much for sharing it with us.
Thank you.
Well, after the break, talking local urban renewal with CEO of Urban Task Force, Chris Johnson, and Raul Mittal from Urbis, Singapore and Kuala Lumpur.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, let's stick with this challenge of urban renewal, where a lot of money is going to be spent, but this time in Sydney, where population growth and immigration levels caused the Premier of New South Wales, Gladys Berejiklian, this week to call for a breather while infrastructure caught up. Well, that was received with dismay by the Urban Task Force, including Chief Executive Chris Johnson. So what should Sydney be doing to solve housing and living challenges? I sat down with Mr Johnson and also Raul Mittal from Urbis. Chris Johnson, let me come to you first, because the Premier's comments recently about halving the immigration rate into Sydney, perhaps by 50%, we all need to have a breather because infrastructure can't keep up.
Well, she's wrong. She's wrong in that only in March this year, 2018, she put out the biggest plans for Sydney's next 40 years of growth that we've ever had. And it was an integrated plan. It had land use planning, it had transport planning and infrastructure planning. So she set out a plan only 6 months ago for the way forward.
But the backflip? Why the backflip then?
Because there's an election coming up, there's tension about growth and change, as inevitably happens. As a city grows, there's going to be tension. At the moment, we've got 30%, according to 2016 census, of people living in apartments. That wasn't the case a decade or two ago. This is changing the nature of the city from a low-rise suburban city to a more urban city. And some people are worried about that, but it's the inevitability of change. If we are going to grow as a city, the other option is to pull up the bridge, stop growth, and go backwards perhaps. That's not going to help the best jobs coming to Sydney. It's not going to help us in our international standing. It's not going to get more tourists into the city. And it's not going to get a good supply of jobs flowing through the whole community. And this is at a very time when the baby boomer ageing population is moving through the demographic charts to produce less people earning income.
Raul, you're at Sistra in Singapore. I think that's City Strategies. We hear that Singapore is maybe 10, 20, 30 years ahead of Sydney. In what way?
So we were discussing earlier with Chris that Sydney and Singapore have the same population. Sydney has a bit more area than Singapore. We're at only a small island of 700 square kilometers, but our density that we live at is almost 20 times of what Sydney lives at. But you don't feel it on the street. There's still in excess of 30% green coverage. There's wonderful parks, beautiful riverfronts and waterfronts. So it is possible to do high density with high livability.
So it is in the planning?
It is in the planning, and that's the only way Singapore can survive, because we're a very small island and we house 5.5 million. We're projected to grow up to 7 million people in Singapore.
Chris, what do you think new urban renewal developments in Sydney must have?
2 or 3 things. One, I think a city as it grows from our 5 up to 8 million or so needs much better public transport. We need a metro system, the same thing that Singapore's got, the same thing London, New York have got, a good underground metro subway system that gets people off the cars and off the roads travelling to work. Once we've got that, we need the density related to those stations along the way. And the plus of that for those concerned about growth and change is it actually protects probably 70, 80, 90% even of the suburban low-rise part of Sydney.
So, Raul, just tell me about the train system in Singapore, because I think you're working on a major development on the train side right now.
That's right. So I think I totally agree with you, Chris. The Singapore is doubling its rail network. We're going from 180 kilometers of rail that already exists to 360 kilometers. We're opening new lines, completely new lines, new stations. But again, we're doing it on the backs of putting density next to stations. So people really want to live in these TOD developments that we call, right next to the station. They want to be able to jump on a train, drop their kids to school, go to a place of work, come back in the evening and enjoy as much time as possible with their family.
Well, Chris, just coming back to the Premier's comments, isn't this putting the cart before the horse? Don't we have to have the rail system first?
Well, there's always a chicken and egg, because part of the new development contributes funds back into the infrastructure costs. So if you say, let's have no...
So that's the value capture side.
It's a value capture, but there are whole lots of levies that come with new development. And so it helps actually make it happen. So if you actually had no new development, put all the rail system in, everyone would say it's a white elephant, there's no people there, where is it? And you've lost the potential to get some of that into it. So I think we've got to move in an iterative way where we're encouraging a certain amount of development along with the future rail system that's going to occur. And that way we get a win-win.
What are the sort of big projects that you're looking at in Sydney at the moment?
Well, there's some good examples. I think Central Park, the project on Broadway, is very close to Central Railway Station, close to universities and buses. It's got a number of towers covered in greenery and landscape, which looks fabulous, and that helps the image of the whole place, but it's got its own park, it's got its own health centre, it's got its own shopping centre, it's got childcare centres, it's got a whole lot of facilities. So people have got all the amenities they want there. It's also got 60 go-get cars in the basement, so people don't need their own car. So this is becoming a more sharing approach to how you live, encouraging people to walk and to use all these facilities instead of having all of it in their own little house.
And Raoul, what do you think of these two enormous renewal projects that are being done internationally at the moment? Firstly, Battersea Power Station in London, and then also Hudson Yards in Manhattan.
I think they're wonderful projects. Both cities are grappling with the same urban issues that we're grappling with in Australia and in Asia. So brownfield redevelopment is the way to go forward, and these are very substantial projects, and what they're trying to do is give not only land back to a more productive use, but also connect cities back to their waterfront. So wonderful examples, and wish we had more brownfield land in Singapore, which we could recycle like that.
Yes, it's all spanking new up there. Chris, interesting that with these new projects that it's actually the private sector putting in the money.
Well, I think there's a shift from governments doing all the infrastructure. I mean, in the old days, the government would put all the roads in, the schools, the preschools, the whole parks and everything for the public domain. The taxation base is not allowing that to happen these days.
There's plenty of incentives, though. I mean, just looking at the New York example, I think there was some controversial tax incentives there. Do you still see this sort of thing happening?
Well, there has to be some incentive for a developer to contribute that back. So they've got to work out the cost of the land, the building, the development, etc., what can be contributed to provide what governments used to provide. And it's a balancing act. Generally, it means higher buildings, more density than we used to have. But that's the trade-off. And the beauty, I think, of taller buildings is it actually opens up more space at ground level. So you can actually get more parks. I think Hudson Yards got 3 parks and a series of, a school even, childcare, restaurants, shops, people living there, people working there. It's a whole little town in its own right. And because it's a big site, you can design it in a way to get the height where it does the best for the whole site, so you don't overshadow the park, for instance. So bigger sites, I think, are the way forward.
Raoul, how do you make an urban regeneration which looks maybe bright lights and concrete? How do you make it full of soul?
Yeah, I think that's a very tricky proposition, and I think what we're starting to see in Singapore now is something we call intergenerational living. So Singapore's got an aging population. At the same time, we've got a falling birth rate. So what the planning agency and the public housing authority are looking at is this co-living, intergenerational living, where you've got retirees living in the same community where there's childcare. So in essence, the younger couples who are both working, they can drop off the kids at the childcare. The grandparents can pick them up after childcare, take them up to their unit, feed them dinner, play with them, interact with them. So the grandparents feel happy. The parents are happy because the children are taken care of, and the children are getting rooted more in the community. So I think that's where we're starting to see a lot more of that interaction happen, which is fabulous.
Oh, look, I agree. I think you need design quality first. You need a good quality development, but there are economics about that. So if the approval authority pushes down the amount of development, the developer, to make it all work, is going to have to cut a few corners. You've got to allow enough development that you can do a really good job. The schemes we're talking about, Battersea Park has got Norman Foster, it's got Frank Gehry, world's top architects involved, similar in Hudson Yards.
And you optimistic for Sydney?
I am. The Central Park one I mentioned has got Jean Nouvel, a French architect. We've got a British architect down at Barangaroo, we've got, but local architects as well. So we've got to encourage local architects. I think there's too much regulation and control, quite frankly, at the moment in our planning system, which stops innovation. We need real innovation from the private sector, from our architects, to do something quite spectacular.
Chris Johnson, Raoul Mattel, thank you very much.
Thank you.
Thank you.
Well, after the break, diving deep into the gas supply with Credit Suisse analyst Saul Kavanagh.
This is Ticky on Your Money, covering the big business stories.
Welcome back. We're moving to energy now, and gas supply was a big topic at this week's AFR Energy Summit in Sydney. I, of course, was in Melbourne yesterday at the Australians Outlook Summit on energy as well. So there's been a lot of policy talking. Here to share his thoughts, I'm pleased to welcome Saul Kavanagh, analyst at Credit Suisse. Saul, you were there, I think, at the Energy Summit. What did you think of the state of play?
Well, I remember when we sat down almost a year ago at the previous and first Energy Summit, and it feels a lot like deja vu.
You mean we're still in the same mess?
The same, particularly on the policy front. So I remember last year the CET had finally just been backed away from,
the clean energy target
at that summit.
I remember that, yeah.
And everything was in disarray, and policy uncertainty was the name of the show.
That was the Finkel reports thing.
That's right. And then subsequent to that, obviously, we saw the National Energy Guarantee Policy, which was
going to happen. It was going to happen, Saul.
It was all moving ahead, and then it dumped amidst a dumping of a Prime Minister not so long ago, and now we sit pretty much back at square one, where we're seeing across the board industry, electricity buyers, sellers, decrying the lack of policy clarity.
But meanwhile, we're seeing more government intervention now. We've got Labor's Bill Shorten coming in and saying, well, certainly there was some sort of reaction to his idea of adding pricing to the intervention in potentially intervening in the LNG export market. How do you see that rhetoric?
Well, it's becoming obviously a increased focus at the conference this week, Labor's gas policy. I think some of the rhetoric being targeted at Labor's gas policy, it's a bit over the top. I think in reality, if we want to look at what practically he's going to do, I think it's very similar to current policy.
To Matt Canavan's policy.
Very similar to Matt Canavan's policy. The difference with Labor's policy is they're being just very honest about what the policy actually is about, which is about bringing down prices. So if we rewind a year or so ago when the coalition's policy was brought in name, it was about making supply available, not about price. But in practice, it very quickly devolved into being about pricing for gas-intensive manufacturing.
Well, I was talking to Angus Taylor yesterday, the Energy Minister, and I was saying, what about your retail reference price that you're giving everybody on the electricity front? When's that going to turn into a cap? So it is very price-sensitive, isn't it?
It is, and I think the electricity retailers should be quite worried by seeing exactly what we've seen in the gas side of things, where that supply availability very quickly devolved into government behind the scenes pressuring for lower prices, and that happened in the space of 6 months. Will the same thing happen now with the reference pricing in electricity?
Yeah, so the pressure on the gas companies like Santos, we've seen deals being done between Santos and Brickworks now, Santos, and these are the users of gas that are saying that they're going to go to the wall, job losses potentially, people like Incitec, Pivot and Orica, but we've seen deals done with, Brickworks and Pratt.
Yes, and Quinos.
Oh, yes, and Quinos. Now, are these deals, do you think they're done, without any sort of tap on the shoulder, any pressure from government?
I think clearly we're seeing behind-the-scenes pressure. So, particularly if we pick on the Quinos deal, it is unfathomable that Quinos can pay market-based net-back pricing for gas. So I suspect strongly that the government has bullied Santos into a sub-market price deal on this one, and this is continuing a pattern that we've seen of government applying pressure behind the scenes to all three LNG exporters to target and support specific at-risk gas manufacturing sectors.
All right, let's talk about the upside. The Trump tariff wars. Wow, that's a silver lining, is it, for the gas industry?
Well, I think Australia's LNG sector should be sending thank you flowers to Donald Trump. Over the last few months, we've seen two things. One is obviously the sanctions against Iran has been seeing support for oil prices, which are going to provide a nice earnings boost to the entire Australian oil and gas sector. But in particular has been the trade escalations we've seen between China and the US, where China has responded by applying a tariff to US LNG that enters China.
So we could see more contracts, between China and Australia.
Yeah, we expect that China will now be pivoting the emphasis away, not just over the short term, but for the long-term contracting procurement strategies, away from US supply and to other supply in the region, Qatar and particularly Australia and PNG.
And more broadly, we've got appetite to invest again in LNG.
Yeah, so the other huge news obviously has been Shell sanctioning LNG Canada. This is a $40 billion project.
Wow.
It is the first large-scale greenfield LNG project to be sanctioned in over 5 years.
Yes.
And very much signalling that the appetite to invest in LNG is back. And we expect to see more large project sanctions over the coming years and more in Australia, for example, Woodside's project at Scarborough, Barossa backfill of Darwin and PNG expansion.
Right. The Sunrise deal, that's Woodside with Timor. Now, what's this? The Timorese government is going to buy out Conoco's stake?
Yes, so the Timorese are going to pay $350 million for the 30% stake in Conoco.
Wow.
It's still subject to the Timorese actually sorting out the funding on their side, because this may require them actually getting money out of their sovereign wealth petroleum fund.
But if they do it, would that cause the deal to actually go, the development to actually happen?
Well, I think, I suspect that Conoco is quite happy with this deal because it was being looked that Sunrise could be developed back to Darwin LNG as part of the maritime boundary negotiations earlier in the year. But Timor have, as they always had, insisted it has to come to Timor.
Yes.
So I think Conoco would have seen this as a worthless asset. They're now getting paid $350 million to take off their hands. There's now a real question of, will that see increased momentum? It would likely require significant, and I'm talking $5 billion plus subsidies from the Timorese in order to make this investable by the other joint venture partners.
Yes.
And then this obviously poses risks to the overall fiscal health of the Timorese government long term.
Briefly, you've just come back from Alaska, and Oil Search's oil prospects, do they look good?
It's been quite a trip up there, flying around in helicopters, searching for bobbing donkeys up in the tundra. It's actually quite a remarkable landscape up there. So there's a lot of there's some legacy oil projects there, for example, run by Exxon. Conoco has a large position there, which is increasing its investment in, and Oil Search now has a project which they recently went into, neighbouring the Conoco project.
So how do they get there? I mean, how do they get to the oil exploration areas?
So it's actually, the tundra and obviously the permafrost is ecologically quite sensitive, and there's a lot of environmental regulation around this. So it's actually quite fascinating. The way you do your exploration is you can only do it in winter, where during the winter they build ice roads to go do your exploration wells, and then come summer all the ice roads melt and there's been no impact left on the tundra. And these kind of very stringent environmental regulations are part of the environment that Oil Search and the other majors have to navigate up there in order to do their operations.
Wow. So broadly, I think, I mean, the market's come off now, obviously, with our market sort of correcting and everything else. But when the first news of the investment, trip over there to kick the tyres, as it were, markets seemed to like Oil Search and, what was up there.
Well, I think that obviously their entry into Alaska became a surprise to many. I mean, going from the tropics of PNG into the icy cold Arctic Circle, and there's now a process.
Talk about spreading risk.
There's a process indeed where Oil Search has to kind of warm up the investment community to what the materiality of that asset is and its attractiveness, and proving that Oil Search can actually operate in such a difficult and remote environment, which has typically just been the area for the majors like Exxon to be able to operate in.
Okay, right. Just pulling it back to here, I just want to ask you one more thing around the domestic market, and that is the talk about the building of import terminals. I mean, this is becoming more and more a live issue that is actually going to happen.
What's very interesting we saw this week is how many gas producers which a year ago were quite wary of import terminals are now coming around to the idea. And I suspect the main driver behind that is a lot of the gas producers would like to see import terminals because it would lock in a higher gas price, being import parity pricing.
Yeah.
It is seeing more momentum behind it.
That's a really good point, actually, because if there is going to be a cap on prices, that's going to be pretty hard because you've got the netback price. You just explain what the netback price is. It's the international price less the shipping.
Less the shipping and your losses and OPEX costs. So roughly speaking, it's about $1.50 to $2.
Right.
That gets you a netback price in Queensland, but down here in Sydney and Melbourne, you have to pay another $2 to get it down here from Queensland. So that's a netback-based price, but an import parity price is you start with your LNG price, and then if you add your regasification costs and pipeline tariffs.
So that's really interesting. I'll keep on that, what you were saying about what the market thinks of it all. But Sol Kavanagh, what a run-through. Thank you very much for joining us.
Thank you.
Terrific. Well, the Prime Minister's policy push was overshadowed this week with divisions on display over religious freedom. Labor called for the government to take action to address aged care concerns, also unveiling its school funding cash splash. This is The Week in Politics.
Scott Morrison got the week off to a flying start.
Whoa! Whoa!
But it wasn't all smooth sailing.
Shame, bloody shame!
With fierce backlash over the decision to use the Opera House to promote the Everest race.
It's not like they're painting it on there.
Bill Shorten was having a bet each way.
So I like racing. The Opera House is not a billboard.
The Prime Minister revealed details of the Aged Care Royal Commission, but Labor called for urgent action.
The government needs to act today about the things it knows are wrong today.
While the Population Minister, or
Congestion Buster,
Alan Tudge, flagged a push to force new migrants to move to the regions.
and require them to be there for at least a few years.
Labor unveiled details about its school funding plan.
We'll put back in $14.1 billion.
What Bill Shorten is committed to is $14 billion of higher taxes.
The Prime Minister's policy push this week was undermined by a relic of the Religious Freedoms Review, and it's threatening to undermine the crucial by-election in the seat of Wentworth with just 1 week to go until polling day. It sparked debate about whether religious schools can or should reject gay children.
I don't think it's controversial in Australia that people expect religious schools to teach the practice of their faith and their religion.
And I would be opposed to any new measures that impose forms of discrimination.
We shouldn't even be having this debate.
Well, it's the existing law.
And another report, this time from the United Nations, providing a stark warning about the actions needed to limit global warming.
It didn't contain any recommendations for any actions by Australia.
This government has again decided to block their ears and ignore the science.
But the PM insists.
At the end of the day, we want to ensure that electricity prices are lower.
Trudy McIntosh, Sky News, Canberra.
After the break, US markets taking a dive, recapping the week that was with my Friday Markets panel next.
Now, back to Ticky.
Welcome back. We're moving to the markets now, and another real slump for Wall Street overnight. The S&P 500 sinking 2%, Dow Jones sliding another 2.1%, but the local market picking up from yesterday's slide to close up 0.2%. Well, it wasn't such a good week for the ASX overall, though. They're closing the week down 4.7%. To recap the week that was, I caught up with Market and Lakos from Macquarie Asset Management, Michael McCarthy from CMC Markets. Well, gentlemen, here we are, and it has been a more interesting week, one would say, in markets, Martin.
Yeah, very much so. This is very much a reaction to an extended period of complacency, Ticky. I mean, when you're both talking about the market needing to correct at some point. Yeah, absolutely. I mean, it's very difficult to get the crystal ball out and predict the timing, but we certainly both felt, I think, that there was rising risks when you think about it. You know, the trade issues, the rising US dollar, rising oil prices, as Mike just mentioned, the midterm elections. But more importantly, we haven't seen a major correction since February, really, this year. So we've had 8 months whereby markets have continued really to continue to perform. So when you have that period of complacency, eventually those accumulation of risks has an effect.
So, Michael, what triggered it? What was it? Come on, what was it?
What was it? More sellers than buyers. The reality is we often try and explain afterwards what happened in the market, but what happens in the market is part of an organic process. It's crowd behaviour, and we don't know what's in the minds of everybody. I think what triggered it was a number of events that were very, very tightly packed. We had CPI data out of the US. Inflation speaks directly to interest rates, and so there was concerns that the 10-year bond might make fresh 7-year highs. We had trade data out of China today, and that had the potential to re-spark the trade rhetoric out of the White House.
Why? Because it was better than expected?
Well, it's an excuse. It's something to hang on, and because it has favoured China much more than the market was expecting, we could hear from Twitter about this issue again very soon, and of course that's bad news for markets.
So that hots it up, and then we've got the midterms as well coming up.
And the problem was in the US, earnings expectations for the S&P 500 companies were at the highest they've ever been, and we're on a very high PE in the historic range. 10 to 20 is the historic range. We're getting close to 20 times the highest earnings forecasts ever. So valuations were as stretched as they could be.
Yeah. But what might steady the markets out is we do have an earnings season in the US about to kick off, and the expectations are once again a pretty strong quarter of earnings, driven to some extent by the tax cuts. There's no doubt that. So that's still in the system in regards to those profit.
But do you think that's
reports.
priced in?
Well, the rally that we had seen leading up to this was probably starting to get priced in. Now the market's pulled back 6 or 7%.
So you think if we have a good reporting season,
it might just steady the markets up.
Yeah. Oh, that is very interesting. Now, what about our own market, Martin? Because we had a reasonable day today. We came out ahead, didn't we?
Yeah, we certainly bucked the trend. And we walked in this morning. Futures were down about 47 points. We've got the first rule read of the futures market opening. It was only down 15 points, and we pretty much held steady through most of the day. I mean, within I don't know, what was the low? Down 15 points, Mike. I can't remember.
Yeah,
down 37 actually. At one stage, very early.
But on the week, we're
down 6%.
We are down 6%. Now, so where does that money gone?
Well, into thin air.
Into thin air.
Well, some of it's gone into bonds, some of it's gone into gold, but most of it has been recorded as a loss.
Yeah, and the rest of it, presumably, the other thing that's been happening is that there's a lot of movement between stocks. Is there this way?
Yeah, there's certainly been a shift within the equity component, but we don't view this move we've seen this week as a shift of asset allocation in terms of to bonds yet. Right. It's not yet time to be going really defensive, but it would make sense in your equity component, your share component, to be thinking about being a little bit more defensive. We still like growth, but just being a little bit more defensive.
That's kind of what's happened in the market today, isn't it? In terms of the stocks that are up today.
We had what the analysts call a beta barbell. So the best performing stocks, the top 10 stocks were roughly comprised of gold stocks, which represents the defensive mindset, and the IT stocks, which have been beaten up, and of course have very high growth and high valuation.
Yes.
So there's clearly some differing opinions in the market.
So they come back. So what stocks have come back on the IT side that have been hammered?
Appen came back very hard. Afterpay was one of the star performers. It bounced off $14 and touched $15 today. WiseTech was one of the top performers today. Xero didn't really participate, strangely enough, although it wasn't hit as hard as the others. But there was IT was the best performing.
But did somebody push the panic button yesterday, Mike? Because those stocks were down 10%.
Absolutely. Yeah. But this is the problem, Martin. This stock was trading around $5 in April. It touched $23 in August and got down to $14. If you've got a faint heart, this is not the stock for you. But for those who want to add some alpha to their portfolio, it's a good idea.
But what is interesting, there was a number of high-quality stocks that, in fact, have been sold off well ahead of this correction.
Yes.
Stocks like Amcor and Lendlease. Lendlease was at $21.50, now $18. And, in fact, yesterday held its own, and today the same.
Yes.
So, again, it gets to a point when a stock has been sold down too hard, and the valuation on Lendlease is around 12.5 times earnings. So it's hardly looking expensive.
Look, we should just touch on one set of results, Fairfax.
Oh, boy, that was tough. So, look, it's not unusual. We've seen plenty of headline losses from Fairfax over the last few years.
Yes.
We've also seen revenue contract before, down by a little over 3% this time. But what was disappointing was that Domain reported alongside them. Now, Domain has been the great hope of Fairfax shareholders. That's where the growth is expected to be.
Well, still 60% owned, is it, by Fairfax?
Exactly right. And expectations from analysts are, on average, that we'll see 16% growth in their profitability in the coming years. Today, they told us in the first 15 weeks of this year, revenue fell by 1%. Now, that is not only very bad news for Domain, it's very bad news for Fairfax. And those stocks were absolutely pummeled today, both around 12 to 13%.
Now, is that because Jason Pellegrino still has to get his sort of seat under the desk and feet under the desk?
Well, there might also be elements of clearing the decks and, you know, getting things into right shape and making sure that this merger goes through. It's the most takeover-like merger I've ever seen.
Yeah, this is with 9.
Yes. So it might be about getting that. And there's no doubt that there's some internal focus on the deal, but you've still got a business to run and you've still got a duty to run it.
And what about the banks today? Because we had Shane Elliott, obviously, in the box, this time up with the Senate committee. Bit of 6 of one, half dozen the other. Some up, some down today.
Yeah, well, ANZ and NAB underperformed today. Westpac and CBA actually finished in positive territory, interestingly. Right. And they did that despite some very weak housing data that also came out today. It just seems it's one thing after another for the banks.
But they've been sold off pretty heavily, haven't they? And on a valuation basis, although they've clearly got some headwinds ahead of you in terms of remediation and obviously the tightening credit markets, at this point in time, they start to look like a pretty interesting value. They may be non-performers for quite a while on until these headwinds subside, but they're at the lowest valuation or equivalent to where they were at the time of the worst of the GFC.
Right.
So they're not expensive.
All right. And so, Martin, where are we going to be on Monday, do we think?
I haven't got the crystal ball out. I actually think we're going to probably have a bit of a bounce. The US futures were higher this afternoon, so I think we might just find the market start to steady out. So we don't see this as a catastrophic event.
You can buy it from me, Martin. I'm looking for a down night in the US tonight. I was up at midnight last night watching the US Open. I've been trading DAX into it. I'll be doing the same again tonight.
Gee, right, fellas, I'm going to go home and have a drink. Nice to see you. Each their own poison. That's all for the show tonight. Until next week. Thanks for your company.